Okay. So then here you make the same $100. And then here you would again lose a smaller increment. Now you'd lose something like $110, right? But you notice even these two trades equals $250 and these trades only equal $300, right? So there's a problem here because good trades are very heavily weighted against negative returns on spots where you're increasing leverage. So we go back to here and you can see how valuable it now becomes to be even more valuable if you were to never have this good trade. So we actually didn't take good trade, bad trade. We took good trade, but we also took out this bad trade and we just focused on making good trade, and no bad trade. We'd actually make more money in this scenario now, even again, because in this scenario, we make, $100. In this scenario, we make another $100. And in this scenario, we lose $140. There's no risk of the second set of trades where it's good trade, bad trade. There's no 50% chance of risk to take there, right? Because this is actually acting as its own kind of good trade, bad trade as its own block of trades, right? So this is actually acting as its own 50-50 proposition. If we're talking statistically just about numbers, now we're not talking about technical analysis. We're talking about bankroll management and how to properly accommodate for swings in your bankroll and how to properly position size and things like this, okay? So for this reason, you are simply better off always going to be in a scenario where if you have good trade, bad trade, it doesn't matter. You can take this out, this out, this out. And by reducing the amount of bad trades you take, you are naturally going to build twice as much money. This is the goal or one of the big goals of bankroll management. Reducing the losses that you take in trading will make you twice as much as the wins will. There's never a shortage to how much money we can make in day trading. You can trade and you can do and take 50 trades a day, and you can have an insane amount of liquidity going through your account, and you can take 50 trades a day, and you can be up, I don't know, let's use our account balance here, $500. Say we made 100% on our account balance and we made $500. Or maybe we even made 200%. Maybe we made 300%. It was a really good day. So we went from $500 to $2,000, okay? And it was one of the best days we could have, right? 300%, incredible, absolutely incredible. And you have 50 or 60 trades. You worked 18 hours. That's fine. You made good money, so it didn't matter how long you worked. And so fine, that's a great day. You'll make more money reducing the losses. If you had, out of those 50 or 60 trades that you took, if you had 20 bad trades, those 20 bad trades will end up losing you more money than the money that you actually make, right? So reducing the amount of money that we lose in trades is crucial. It's always going to be crucial. Unless you're using a specific, let's say you make 3%, unless you're using a percentage base and you lose 3%. If you're using just a percentage base on trades, fine, you're going to equal out more, but it's still not going to be even, right? You're still going to lose more than you make in a 50-50 scenario. So this is a very important concept to understand, is that reducing the amount of bad trades we take should be our number one focus. It shouldn't be, let's get into 60 trades a day. We can have that same result of making 300% by taking the right trades at the right time, okay? You don't need to be taking 60 trades a day. Now, if you're taking 60 trades a day and you can still procedurally do them properly and technically do them properly, you're probably going to be making a lot of money and you're going to be even doing even better. But if in both scenarios, let's draw it out like this. We're going to get rid of all of these. In scenario one, you took 60 trades and you made, let's go like this. You took 60 trades, okay, and you made 300% because it was a heck of a day, like this, right? This has a lot of variance in it, right? This 300% is always going to, or is also going to have days of variance where your percentages are swinging the other way quite rapidly too. You're going to have days where you lose half of your account because you've taken so many trades, right? That a volume of trades will hurt you in the end as a newer trader, as somebody who's not doing this as a high level professional. Now, a high level professional, sure, you can take 60 trades a day and you can do this all day long. And if your track record is there and you can consistently do these kind of trades and profits and volume, great, this doesn't apply to you. But for 99% of the people out there, this will apply to them. If you can have those same results by taking 20 trades because you reduced, let's maybe say it's 30. Let's say in this 60 trades, you had 20 bad trades, right? Now that's still quite high, but let's say you had 60 trades, 40 were good, 20 were bad. Okay. This is the bad box right here. We'll put a B there. Not very good at all. We'll go like this. A B like that. B for bad. 20 bad trades. You could have that same 300% result by reducing this down to 5 or 10. And by reducing this number by half and reducing this number by half. So if you only took 30 trades and you simply did that with only 5 bad trades, you're going to have more stability in your account growth. You are going to have less variance over time as you are competently trading. You're going to have less variance, less swingy days. So in order to reduce variance in bankroll management, you have to reduce the bad trades. It doesn't mean you have to always be in the right trades. It just means you need to focus on reducing bad trades. Okay, so we have, that's a terrible 5, but it works. And this is 30 trades here. And this is our bad box. We're going to call it the bad trades. This is our bad box right here. B for bad. And you had, I don't know, maybe 30 or 20. We even just say 30 total trades. So 25 good trades, 5 bad trades. This is going to reduce the swings in your account by taking less trades. And it's not that you're working less. You are just focusing on reducing this number here, and you will make twice as much. If this happens once a month, when you have 20 bad trades, if this 300% a day happens once a month, in this scenario, it's going to happen maybe 2 to 5 times a month. If you're working 6 days a week day trading, it's going to happen somewhere between 2 to 5 days a month. So naturally, you're just going to scale your account and maybe even more, maybe 6, maybe 7. I don't know. That's all dependent on you guys and how good you are at day trading. But procedurally, this is the way we reduce variance in our account. We focus on taking less trades until we are more comfortable with it. And we focus on taking less trades, and the focus needs to be on reducing the amount of bad trades we enter. Okay. So that's very, very important to understand. Reducing the bad trades. Again, this will make you, if you were to make 100,000 a year, in this scenario, you could do the same amount of work and make 300,000 or 400,000 in a year, your yearly salary, 300,000 or 400,000 a year in this scenario, just by reducing the bad trades. Because reducing bad trades is really the key to proper bankroll management. It's not like, it's people who know poker will understand this analogy. In poker, we look to enter the most optimal situation for the hand we're in. Okay, say we're in a tournament and we have so many chips left and we are blinding out. Now, if you guys don't understand poker, that's okay. We'll just say we only have a small amount of chips left and we're in a tournament. And so basically we have to pick a hand and just kind of go with it, right? That's different in trading. There is no situation where we're ever forced into just going with it, right? We can wait for pocket aces every single time, right? We can wait for the most ideal situation. Or maybe we play with pocket tens and jacks and all these things. Same thing with day trading. There is no kind of time bomb, or there is no cost to watch day trading, right? The benefit here is that our balance should always be in USD, right? So it doesn't matter if Bitcoin goes up or down. It doesn't matter if it goes to $10. It doesn't matter if it goes to $100,000. We still have our $10,000 in our account, or whatever balance amount we decided that we had in this account. We still have that. There is no cost to watch. So all we do is we reduce the amount of bad situations that we ever need to be in, and we can grow our account in a much more natural way. So you have to ask yourself, okay, do I have a lot of variance in my account? If you do and you notice, so this is something that people also, if you don't have a lot of variance in your account, this is something that you have to be aware of and privy to. And you have to be able to say, okay, when variance occurs in my account, what's happening? Probably the amount of bad trades you're taking is increasing. Okay. So that's the first problem. When you have high variance in your account, high swings, ups and downs, and 50-50 scenarios where you are kind of stuck in this polarity between making money and then losing it, making it being break even and sometimes being up and some weeks being down. This boils down to how many bad trades are you entering. Okay. So again, a reduction of bad trades reduces variance. So we're going to put that right here. A reduction of bad trades reduces variance. So this is very important to understand. Purple. It's we need a really bright color here. There's a pretty vivid color. A reduction of bad trades reduces variance. So this is crucial to know. This is beyond crucial to understand this. Okay. So that tackles that problem. So now you know how to reduce the amount of variance in your account. Okay. You now understand what you should be doing in terms of position sizing. Okay. If you lose, like if I was to just open a position and go max leverage here, and I said, oh, I'm very confident in this position. I've got $544. I want to go 100x isolated on a contract, isolated. So 100x. I'm comfortable taking that risk. Even if I liquidate my account, I'm going to still have 19 positions to back it. And I can slow down and say, wow, that was stupid. What kind of mistake did I make? And I can go back and I can analyze, was it procedurally that I made a mistake or was it technically? Right? Again, going back to the earlier trade, the perfection of getting this right here within 1 cent of entry. Technically, I was a laser beam, right? So you guys would expect nonetheless from me. That's why you're here. So that's fine. I was an actual laser beam on this buy. So technically, I didn't make a mistake. Okay. And then technical analysis wise, I should have sold here at 86.99. Like I said, I was going to. Procedurally, I made a mistake. So this is where, when you are taking trades, you have to break down where your flaws are. Are you making procedural mistakes when it comes to impatience, ego, entering a bad trade? Or are you making technical mistakes? Or did you mark a level wrong? Did you miss a trend? Did you not see that this level was already tested back here, right? All of these things, like what happened that you missed your mark and that it fell right through the level? Sometimes I see people set a buy right here, not understanding the deeper reaches of technical analysis. And they set 100x leverage because they think it's going to hit, and it just goes straight down, and they liquidate and they have to panic close, or they lose half of their account or whatever. It happens all the time. There's a lot to understand when it comes to technical analysis. So it's not some quick 2-minute thing that we do, right? Technical analysis, there's a very deep mindset and a deep game that gets played there. If I was looking to take the next trade here, what would I do? So we've broken down how to reduce variance in an account, what a bankroll should look like. Now, again, I don't think you need as much as 40 rebuys in your account, right? Like if you have $500 in your active account, I don't think you need $20,000 in your account. If you want to be extra careful and extra cautious, you don't say you have 20 rebuys. What you do, 40 rebuys. What you do is you still have that same 20 rebuys. So the same schematic that we've drawn here, right? The same blueprint that we've made. Funny blueprint. The same schematic that we've drawn. And instead of going max leverage and having 20 times that you could be wrong and you lose your bank account, all you do is you break this into positions of 10%, right? So then you have 10 positions, right? So then you'd risk $50 and you would say, okay, I want to make a risk here of $50 and just going to pick an arbitrary level and buy. And if I get completely liquidated on that account, I still have 19 more. So if you, instead of $500 or we're at $544, I believe. So if I lost $50, I would be at, here, let's actually put it to the max here. I would be at 494.14 if I got absolutely liquidated. So that would give me 20 positions, or 10 positions within this $540 account, right? It would give me 10% positions. So then I would have that 20 times. So you're talking about having to lose 200 trades in negative, right? Because you have to lose 10 trades. So wait, did I do the math on that right? Yeah, 20 rebuys, 10 trades each rebuy. So you would have to lose an insurmountable amount of trades in order to liquidate an account. Okay, so if that's happening, you have major flaws. You can start out like that with, $500 in your active account. You can say, okay, I just want to take 10 positions. This gives me 10 trades that I can screw up. And in a worst case scenario, if I have a really bad day and I somehow go into 15 trades, 5 of them are good and 10 of them are bad, and I end up, well, actually, you'd have to go like 20 trades, right? Because you'd have to go 5 good, 15 bad. Let's just say, straight numbers. Then after 20 trades and you made 15 bad trades, you liquidated your active account and you still have 19 more active accounts sitting behind that. And you can sit there and say, okay, what did I do that was so silly that made me have these mistakes, right? And then you can kind of analyze where you're making your mistakes. Is it procedural or is it technical? Because again, there's a very, acute difference between the two. So recognizing if it's procedural or if it's technical is the first and foremost thing. And then so fine. Once you get more comfortable, you can simply slide this up and say, oh, I want to take a 20% position. 20% of my account, right? I want to take 5 20% positions. So I can only have 5 bad trades because I'm more confident in my technical analysis and so forth and so forth. And you can eventually scale this up to the point where you have, 20 kind of positions in your account. And if you want to have 40 positions, you just do half and half positions. You just go 50% like this, right? You go 50% positions. Very simple. And now you have your 40 positions. You have 2 positions per active account, 20 positions in your actual account, right? So this is a very good way to manage risk. This is a very good way to understand how to reduce variance. So the degradation of an account doesn't happen. So you don't slowly bleed your account away. You know how that when you have downswings, we'll call them downswings, or when you have variance, there is no random factor in day trading. There is no, I have aces. My opponent had ace king and he flopped a straight, right? Or hit quads or something like that, or trips or whatever. There is no random variance in day trading. There is no, I entered a position, there's a chance we lose here. There's just the right technicals and the wrong technicals. So there is no random factor. You're literally playing with aces every single time you enter with 2 aces in your hand, pocket aces. Every single time you enter any trade, you just have to pick the most optimal positions. There is no randomness. So we don't statistically have to have, say, some kind of 51% ratio over hundreds of thousands of trades to make money because 49% are bad and 51% are good. And then we work to increase 52%, 53, 55, 60, 61, 62%, now we're like pros. That doesn't exist in day trading. That doesn't exist. Every time we take a position, we can just sit there and take the most optimal position. There's no cost to watch. Our money is in our account. We take the trade when we take the trade. So what? So what if Bitcoin goes to $100,000? You don't need to be in it. This is not about riding some fantasy wave. We don't care as day traders. So I've told people this before. So this might sound like a bit of a repeat, but okay, I'm going to say it again anyways. As day traders, we do not care if Bitcoin goes to $1 million overnight or if it goes to $5. We still log on, make our few $1,000s a day, 5,000 or whatever you make a day trading, and we log off. We keep our balance in fiat currencies, in anything. We're not investors. We don't go and buy gold because we think it's going on a run. We day trade it, okay? We don't buy Bitcoin because we think it's going to $1 million. There's no harm in having your balance in fiat, right? There's no harm in this. This is how professionals do it. We don't hold Bitcoin to hold Bitcoin. The grind isn't to go and get 10 Bitcoin or however many. It doesn't matter, whatever it is, how many contracts in gold you can have. It doesn't matter, right? These things don't matter. How much stock in gold? It doesn't matter. It doesn't matter if gold goes up or down. All that matters is our balance every day and what we do as a living and the money we make as day traders. So if Bitcoin goes to $1 million, so what? We weren't in it. I don't care. I don't care. You don't care. You shouldn't. You might. You shouldn't. And then if it goes to $5, we're still safe, right? It doesn't matter. So this is like another big misconception is that you just keep it in fiat. There's no cost to be on the sidelines in this game. If you think this hold level right here is going to reject and this is actually moving down, then short it. Again, this is not a trade I would strongly advise on. I think it's okay, but I think the risk doesn't really make sense here versus what you're trying to do while it's laddering up off of a hold level. So there's some other reasons why I don't think this is a good trade. However, that's up to you. You can just sit on the sidelines and take this trade whenever you want. You're not forced into it. This is something you guys have to get through your head, okay? Let's make sure we got this. There's no cost to sit on the sidelines. You can wait for 2 aces in your hand every single time. So do it, right? Go to, well, let's talk about a trade here for a second. Okay. Let's talk about a trade. Okay. So what would be like a smart place to buy right now? And I'm not even going to do any technical analysis. I'm not going to go and chart Bitcoin. I'm just going to do a very simple, rough breakdown of what makes sense here to buy and what makes sense here to sell. So we're not even going and using our full toolkit. We're just doing a very quick summarization. So we know we just dumped. So if we move up, where's a good spot to be in? Well, okay, right there. You have a 1 hour hold level at 86.5490. That's a great level to buy as a short, right? As a margin short. Yeah, right there. Perfect level. Monitor it. Be at your screen. Don't set it and forget it. It's not the slap chop or whatever it is. And if we want to reduce risk even further, we can go inside of this trade and see where that 86.40 level is right here. And we can go and start finding the smaller values inside of it, 86.40. So we have 86.49 if we want to be really greedy. 86.49 is right there. So this looks like a pretty good spot to short. And then we could even, you have 86.50 here, which is the break level. I don't think it's worth it. I think you just make a choice between this 86.40 level and maybe the inverse to that value. I think you just take that level right there, actually. I think you just take this 86.49 level and hey, it's a 1 hour hold level. It's a great spot to take a short on and you manage a position. We don't have to do anything until it gets there. And if it doesn't go that way, well, what are we looking for over here? Well, we need to see the next hold inside of here, right? So possibly 85.25. Let's go to a 5-minute candle and see, you know what? We know what we hit there. Let's see what's further inside of here. So you do have another little level here at 85.55. So 85.56 would be another okay level. I think it's a little risky. I don't think it's as clean as this one was back here for different reasons. So this would be a good spot to long as well, just as a trade. And there's no harm to sit here and go like this, okay? There's no harm to go like this. And say our next buy is right here as a long, and our next short is right here, and everything in between we don't care about. There's no harm in that. You're going to make money on either one. You know, so it comes back to here, which would be this hold level right here, and you make 40% on 100x. And this is very, very clean, very simple. Not much wrong here. Or, you know, it comes and goes on the bottom side and you have a sell right here. So it hits this level here and maybe it comes up to that one, which you see is lined up on the left side, or maybe it comes up to here, 40% on either side. So there's two very clean 40% trades here. You can use a little bit of a larger leverage on and hey, look at, you just made, you know, how much percentage in one day on one trade, right? Just like we did when we hit the other level right here and we got within a cent of it. And you know, had we sold the right level, what kind of profits would we have made? Yeah, that's 40% as well. So it exists everywhere. 36%. It exists literally everywhere. 40% here and there. And these are small, tiny moves. Sometimes you get trades where you make 3 and 4% on spot, and it's like 300 and 400%. And you've used big leverage. So, bankroll management, the whole point to this spiel here about, where we can buy and what we would look at, like this is how I would look at the trade. And even right now, I would say, okay, well, this is probably inversing right now off of this, which it did. So people are trying to short that, right? And it's going to go back and try to hold this, and so forth and so forth and so forth. You guys know the technicals. This isn't a lesson on technicals. We don't need to break down what's going on here technically. So yeah, the point of this is that, like, why do you have to take any risks? Why do you have to force yourself into trades? Do your technicals, do your procedural, and then make decisions that make sense, right? This is very straightforward, very simple, easy to apply, right? This is just the application of your technicals and your procedural thought process. So this is, again, the whole point of this is you don't have to be in positions, okay? Again, it's not poker. There is no statistics. We have the benefit of just waiting for the most optimal scenario. So proper bankroll management will take you there and, guide you to being able to grow your account properly. So yeah, I hope you guys enjoyed this bit of talk on bankroll management. We're going to further break down bankroll management in the coming series in the blueprint. So in different ways, like how much would we risk in position trades, scalp trades, swing trades, when to take them, when not to take them, how to kind of break your positions into multiple sizes. Because all we did was talk about one position at a time here. What happens when we want to be in 4 and 5 and 6 different trades at once, right? So these are the things we're going to continue to talk about in the blueprint. And I think that's good for just bankroll management and for people to open their minds and start to grasp a little bit of more of a professional setting for bankroll management and how it should be, as an opening statement, what are the must knows about bankroll management? We covered it pretty good today. So, okay, everyone. Adios. See you on the next one.